Hello everyone, in this video about how to hedge your portfolio against market crashes. Please pause the video and read the disclaimer. Okay, what is the reason for the market to crash? Okay, first reason or market to correct. So it's not necessary to crash, but there is a probability for the market to correct. Okay, the first reason is because the US stock market is extending too much to the upper side without any healthy correction. So it's very normal to see some kind of correction to the support area and after that continuing to the upper side. This is from the price action viewpoint. The margin depth of the US stock market is going to the historical danger area and going to the level of which was at 2008 and 2000 at the time of the dot-com bubble. Inflation, actually the price change of percentage change of the consumer price index is going to the historical level 2 and is going to a danger area, and the CRB index, the commodity market is rallying and the price of the commodity is start to increase. So this is another indicator of inflation. S&P PE ratio is going to the historical area and the market are now extremely overvalued and going to the level of, which was at 2000 at the dot-com bubble. So the PE ratio of the S&P currently are 44. It's too high and the market are extremely overvalued. So what is hedging? Hedging is protecting our portfolio against drawdowns, okay, against a specific factor. Sometimes we want to hedge our portfolio or protect our portfolio against the market move. As we know, 70% of the assets or the stocks movement, price movement are coming from the market. So when the market is rallying the stock, we see many stocks are rallying with the market, and when we see the market is correcting, we see most of the stocks are correcting with the market. So if we want to hedge against the market exposure, there's many techniques to hedge against market exposure, against the sector exposure, against the specific industry exposure, or any other factors. So I will cover only the techniques which are which we will need to hedge our portfolio against possible corrections in the stock market. Okay, so one of the techniques are buying options, okay, buying a put options on the stock which we own. So it have its own pros and cons. For example, options are available for the US investor because the US investor, they don't have access to the CFDs. They can't trade CFDs, is forbidden in US. You know the cost of your, like when you are purchasing options, like you are purchasing insurance policy on your stocks, and you know that your cost from the beginning, less margin requirements than the other asset classes. The cons are very complex for the beginners. Options pricing are very complex for the beginner to understand, and the coverage of the insurance on your portfolio are for the specific period. For example, if your options expired and the market are still going down, it will be a problem for you because you will go to the negative territory. We have another type of hedging, which is investing in gold, purchasing gold. If you see these two lines are gold spot and gold ETF and GLD actually, and this blue line is US stock market. You see that there is some kind of negative correlation between the two. When the one is zigging, the other are zagging. So this shows there's some kind of negative correlation between the two asset classes, and the investors are tend to go to gold in the time of the crisis. So there is some kind of market behavior when the market are crashing, investors are going to gold. So this will be also an opportunity to hedge against our against the market exposure, our market exposures. Another type is short selling the other stocks. So in this video, I didn't cover going to bonds, okay, going to bond market. I'm only focusing on the stock market. For those stock investors they are purely stock investors, they are not going to the fixed income, okay. So in this video, I only focused on stocks. So if I have a stock account and I want to hedge my portfolio with the stocks and with the derivative of stocks, okay, and with the commodities if I want, or ETF. For example, in gold we have a GLD, we can invest in GLD very simply with the same account, okay. For investors which they have access to short selling and they can short sell in their same account, they can short sell unhealthy stocks of the companies which are unhealthy, but it's very difficult. This type of hedging are very difficult for the beginners, so I am not recommending it for any beginners. Short selling the sectors ETF. So if you have a health sector stock, you can short the health sector ETF. And the most simple type of hedging against market exposure are shorting the market itself. I mean by the market is SPY, shorting the S&P 500 index fund. So for example, if we have 10 stocks or 20 stocks, high quality stocks, we can hedge their exposure to the market by shorting the market itself, going short on the market itself. Or if we don't have access to shorting the markets, for example, our broker do not allow us to short, or we don't have the capital requirement to short, we can very simply invest in the inverse ETF of the SPY. For example, SPXS is the inverse ETF of the SPY, but it's a leverage ETF. So we can't just go dollar neutral on the ETF. So in my next video, I will show how we can allocate the capital between our portfolio and our hedge position in the inverse ETF. For example, if I have a portfolio of $100,000 of stocks, how can I hedge, how much I should purchase from the inverse ETF to hedge my market exposure. So thank you very much for your listening, and very sorry for my bad English. Enjoy your time. Bye bye.